The top business stories live from the Sky News City studio. The United States Treasury Secretary tells Sky News the US is not trying to decouple from China. Nearly 1 in 3 British consumers say they'll spend less on Christmas shopping this year. Plus, asking prices for homes in the UK rise at their slowest pace since 2008. Good morning, this is Business Live with me, Ian King. The United States Treasury Secretary has told Sky News the US will back Israel unequivocally in its fight against Hamas and can afford to support its military needs while also backing Ukraine. In an exclusive interview, Janet Yellen also said that the US was keen to maintain a deep economic partnership with China and was not trying to decouple from Beijing. She's been speaking with my colleague Wilfred Frost, who asked her whether the strained relationship with China was at its lowest point.
We've set out clearly, both to Americans and also to the Chinese, a set of principles that we see as governing our relationship. And they are essentially these, that first of all, we will always protect our national security and take a stand against human rights abuses. That's non-negotiable. But with respect to national security, we will our objective is not to harm progress in China. It is really oriented at national security, and we will try to design our interventions, things like export controls, narrowly to keep them focused on real national security concerns. Second, we are not attempting to decouple from China. We have a deep economic relationship, and that kind of competition, trade and investment is beneficial to both sides, and we want an environment in which it can continue. And third, we need to cooperate on a variety of global challenges, and I would say climate change is an obvious example, and this is for both in the interest of both of us and the globe as a whole.
I just wanted to dwell on your extraordinary career at the end. I mean, obviously, the first female Treasury Secretary, the first female head of the Federal Reserve before that, and I'm not sure you get enough credit on that, partly because you're so modest, but certainly not in the UK. And I guess my question as it relates to that is whether you do think you've contributed to breaking the glass ceiling in the US, and whether the US might be getting closer to being ready to elect a female president next.
Well, I think women have made tremendous advances, and I'm very heartened by that. Once upon a time, I think when I started in economics and policy jobs, it was pretty rare to see women sitting at the table, and that is changing. But there still are barriers, and it's important for us to try to break those down so that more women have opportunities.
Well, and long may it continue, and congratulations on all of that. My very quick final question, I know you're not backing a woman to be president in the next election, because I know you'll be backing President Biden loud and clear. Does he still have the energy for another 5 years in the job?
Absolutely. He's very involved, very vibrant, is doing an excellent job. And I think when we face the kinds of troubles that we have in the Middle East, you can see the benefit of deep experience and understanding of global issues.
And Wilf joins me now from Luxembourg. Wilf, one of the things that really I found quite interesting in your interview with Janet Yellen was that you raised the US deficit with her. There's a lot of concern about advanced economy debt right now, and she was quite reassuring on that, I felt.
Yes, that was certainly her message, of course. But I thought what was interesting about her answer when I said, you know, can America afford to be supporting 2 wars at the moment? Her answer unequivocally, absolutely they can, was that she did acknowledge in the medium term the need to bring spending down. So it was a sort of Short term, we're strong. We can do whatever we want. Don't worry about things. Medium term, we do acknowledge that we've got to bring in spending a little bit. Of course, the Republicans, certain wings of the Republican Party in Congress, want them to rein in spending immediately, and there's still no speaker in Congress, which is limiting the ability for President Biden to pass any significant legislative bills as things stand. So there is a lot of pressure on that in the short term. I do think in the medium to long term, when asked whether the flaw was in with the US-China strained relationship, she said perhaps that is potentially a big turning point for the global economy going forward.
Well, thanks for that. Now, nearly 1 in 3 British consumers say they'll spend less on Christmas shopping this year. That's according to the latest consumer sentiment survey carried out by PwC, the accounting and business services giant. The survey suggests consumer sentiment is a little changed over the last month. While continuing to improve among the over 55s, sentiment has deteriorated among the under 25s, while those aged between 45 to 54 are least optimistic. Well, joining me now is Lisa Hooker. She is the Consumer Services at PwC. Lisa, welcome to you. I mean, under 25s are traditionally the most optimistic in your survey. Are you surprised to see sentiment dropping off?
I am at this time of year because usually they're going into education and full-time jobs. And so usually they are the most positive in the autumn. But I do think they have seen a little bit of a downturn in the job market and are finding things a little bit tougher. And I think that's shown in the results that we've seen.
Over 55s have traditionally been the least optimistic. Why do you think sentiment's picking up there?
I think because a lot of the over 55s have paid off their mortgage, have savings, and so are earning interest on their savings, and often will have triple lock on their pensions. So actually, they're feeling reasonably comfortable in their finances.
Although it's worth reminding people that the 2 younger age brackets, 18 to 34, are still the most optimistic in this survey.
Yes, I always think that obviously some of the younger generation haven't seen the years and years and different ups and downs in the economy, so typically are the most confident. And quite a few are still living at home, so do have money to spend on going out and buying a few luxuries. Now,
it's quite striking a number of people who told you they're going to spend less on Christmas shopping this year than last year. But the same thing happened last year. You were picking up this message this time last year, and actually spending was quite robust in the end.
Yeah, so we're still hopeful about Christmas because our consumers are really prioritising time with their family and celebrations. So I think they are quite cautious. So they're saying they're going to be careful, they're going to shop early and budget. But I still think there's a chance for Christmas still to be okay, particularly with inflation starting to come down.
Quite striking that 1 in 5 people told you they've already begun Christmas shopping.
I think that the whole thing is they're trying to budget and make sure they don't run out of money for what they think are important family events. So people have started early, really, to help them in terms of managing their finances.
What sort of things are they buying? Did you dig into that?
We haven't dug into it, but actually it tends to be the start of buying Christmas presents. But I did see when I was shopping this weekend in the supermarket that mince pies were already on the shelves. So I think for some of the long life food, they'll even start shopping for that as well.
In terms of, as I say, the year on what you picked up this time last year, is there any read across from what you've learned this month for the high street in more broad terms?
I think it's just incredibly volatile. And I do think the consumer sentiment does change a bit with hearing a lot of the bad news on the press that you get at different times of the year. So I still think we've got to take any of these surveys in the context that actually as things improve and inflation comes down, the surveys can start to improve quite quickly. So I am quite confident that actually things will not be too bad and people will look to be out and about and doing things and shopping and celebrating.
All right, Lisa, got to leave it there. Good to catch up with you this morning. Thank you.
Thank you.
Some other business news stories for you now. And asking prices for homes in the UK have risen this month at their slowest pace at this time of year since 2008, according to Rightmove. The property portal said today that average new seller asking prices rose by 0.5% during the month. That's well below the long-term October average of 1.4%. Rightmove also said that the number of sales agreed this month have been running at 17% below this time last year. US healthcare regulators have given priority review status to a combination of AstraZeneca's blockbuster cancer drug Tagrisso with chemotherapy to treat an advanced type of lung cancer. AstraZeneca said today that the US Food and Drug Administration had made the decision following a late-stage trial that extended the survival of patients by nearly 9 months without the cancer progressing. Well, the FDA is expected to make a regulatory decision on the treatment during the first 3 months of next year. And shares of Audio Boom fell by more than 4% this morning after the podcast company reported a big drop in sales. The company, whose podcasts include Trigonometry, Dark History and No Such Thing as a Fish, reported sales of $45.8 million for the first 9 months of the year, and that was down 20% on the same period a year ago. Well, Audio Boom said this reflected the loss of the Morbid podcast, which left the network in May last year, along with a weak advertising market. Well, Wall Street's reverses on Friday evening were followed by declines for equities in the Asia-Pacific region overnight. All of the main indices finished lower. As you can see, the Nikkei in the top left-hand corner, that fell by more than 2%. Well, in Europe, stocks are also in negative. Well, look at that. They've perked up a little bit since I wandered into the studio. The MIB in Milan now 0.25% higher, but largely you could say sentiment is pretty depressed ahead of events in the Middle East, where, of course, we expect a ground invasion of Gaza any time now. Well, Poland's main stock index, which isn't on the screen, I can tell you that finished up 4% after the ruling Nationalist Party appeared to have lost the election, pointing potentially to a repairing of links with the EU. Well, here in London, the FTSE 100 is higher, currently up nearly 0.2% higher, in fact, thanks to gains for the mining heavyweights and the oil majors. In percentage terms, St James's Place is the biggest FTSE gainer. That's rallied, you'll recall, on Friday. It sold off by more than 20%. Other gainers in the FTSE right now include Severn Trent, which has received a push from one of the brokers this morning, 2% to the good just now. Among the fallers, well, GSK and AstraZeneca are both lower. That comes after their US rival Pfizer cut its full-year sales forecast late on Friday. Outside the FTSE, Hypnosis Songs is off 10.5%. That's hit an all-time low after the company scrapped plans for its latest dividend. On the foreign exchange markets, there has been a lot of safe haven buying of the US dollar. A lot of currencies in Asia-Pacific in particular hitting lows against the greenback. And the Reserve Bank of India, in fact, has been selling dollars in the market today to support the rupee. Over on this side of the Atlantic, well, sterling up 0.1% right now against the dollar. It's off by more than 1/6 against the euro. The single currency up, meanwhile, 1/5 right now against the dollar. As for the oil price, well, that spiked higher on Friday evening to trade above $90 a barrel for the first time in a week, and that completed its best weekly gain since February. Hasn't moved that much. Today, a barrel of Brent crude currently changing hands at $90.75 a barrel. That is off a little over 1/5 right now, under that. Well, joining me now is Russ Mould. He's Investment Director at AJ Bell. Russ, good to see you this morning. Let's start with oil-related things, because Shell has hit an all-time high today.
It has, yeah, just up around the £28 mark. I'm sure that the chief executive, Wael Sawan, who took over at the end of last year, would like to bag a bit of the credit for that. But as much of it's just down to the strength in the oil price that we've seen. That's been accelerated by those dreadful events that we've been seeing in the Middle East. But oil was already ticking high because of that. Simply because we're finding the transition to a more renewable future more difficult. We haven't drilled for an awful lot of oil because oil companies have been told not to, so they've listened. So we've still seen oil demand going up and supply hasn't been keeping up. That's been underpinning the price of crude and certainly helping the price of Shell.
Ross, what about this situation in Hypnosis? I mean, another big fall in the share price today.
Yeah, deep sigh on that one. I think the most interesting thing there now is that shareholders get a vote at the end of the month as to whether to decide to persist with this one or not, or kind of wind the structure up. It's a slightly unfortunate situation with the dividend. It's a legal ruling in the US by the US Copyright Board, which means that Hypnosis won't receive as much cash as it thought from royalties from 2018 to 2022. So it's cut the dividend. That's kind of adding dividend insult to share price injury, given the shares have been very weak over concerns about corporate governance, structure, transparency of how the royalties are paid. As what's ostensibly been an income stock, for it to then cut the dividend is really not particularly good, and understandably people are quite upset today.
What about the position of Mert Mercuriadis here? He's the founder and CEO, Russ. I mean, he more or less invented this asset class.
Yeah, I mean, on the face of it, the concept is a really good one. You know, you assemble a catalogue of music royalties, and you maximise the value of those by banking a royalty every time that music's played, not just on the radio, but in a film soundtrack or in a video game. So it's a really, really good concept. It just doesn't seem to have quite delivered. And I think the way in which the catalogue was assembled through debt and through rights issues has probably slightly caught up with the company. And yeah, I mentioned the corporate governance issues there. The fact that a new advisor was brought in, Hypnosis Songs Capital, that was going to be an advisor to the Hypnosis Songs Music Fund, and then there was going to be a sale between the two. I think the lack of transparency there, yeah, I don't think Mr. Mercuriadis has ultimately done himself as many favours as he could have done for all the strength of the original good idea.
Now, another piece of corporate news that caught your eye this morning, Russ. Fraser's Group raising its stake in Boohoo.
Up to 15%. Intriguingly, the Boohoo share price hasn't flinched. So I don't think anybody's expecting this to lead to a takeover. Boohoo shares are trading at an 8-year low. There have been consistent challenges over investigations into the supply chain, worries over inflation, cost pressure, optimism of the youthful customer base and whether they're going to start cutting back or not. And as we all know, the Ashley family do like a bargain. So maybe they're seeing one here in Boohoo at that 8-year low in the share price.
You think this is all it is? It's just Mike Ashley having one of his regular punts on another stock in the sector?
It feels like it because the Boohoo share price action, the lack of action is telling you it doesn't. People don't expect a bid to be following through. No.
Now, over the weekend, of course, we got more developments on the Manchester United story. The share price has moved sharply to the downside in pre-market trade.
Yeah, it looks as if the Qataris have pulled out, which leaves Jim Ratcliffe of the Ineos chemical giant as the lead bidder. But he's looking to take a stake, not buy the whole thing. It would still value the club at £5 billion, which is one of the most valuable sports franchises in the world. But I think that the fact that you're not getting a complete takeover here potentially will disappoint some. Remember, the shares were floated at $14 on the Nasdaq back in 2012, and they were still trading at about $14 before this, the talk of the Glazers looking to sell broke last year. So, I must be careful what I say for a fear of upsetting their fans, but it looks as if there's some work to be done on the pitch. I know the stadium's not on the Euro 28 roster because there's some work to be done there. So there is some big investment to go in, and I think Sheldon were possibly hoping for a bit of a clean break rather than being involved in possibly the rebuilding programme on and off the pitch.
Yeah, quite so. Russ, have to leave it there. Good to see you as ever this morning. Thank you.
Thank you.
Still to come here on Business Live. Is UK venture capital investment too southern-based? Don't go away.
You're living with your mum. It's hard to be a rebel, but you get your washing done. And you can skirt around the issue, you can rock around the clock. And no one will ever miss you if you put it on TikTok. So I finally come to realize.
It was shot in Jamaica on the Rio Grande.
Well, fantastic little clip that we got there. And so am I right in saying that most of your career was behind the camera? This is your first album?
Kind of. I mean, it was primarily behind the camera, but I was with a band called Big Audio Dynamite with a gentleman called Mick Jones from The Clash during the 80s. So it's not my first venture in front of the mic. It's my first solo venture in front of the mic.
And now you've released it and it's sounding so great, do you kind of regret you didn't do this sort of thing earlier, or you just completes a great career for you?
Not at all. I never really wanted to be a pop star or switch lanes. I mean, this record is a product of the COVID lockdown, and which was interesting, right? Because what was interesting about COVID lockdown, it gave you a lot of time to think, didn't it? Mm-hmm. What was bad about it was it gave you a lot of time to think. So with 67 years of living and this conundrum, it kind of fueled the lyrical content for this album, and I felt that the time was right to get it off my chest.
And we obviously got a glimpse there, but what is the central message, if there is one?
A central message: speak the truth.
Mm-hmm.
I mean, in times of crisis, that's all we've got, and it's the most powerful weapon we have at our disposal. So all I've done is try to speak the truth as I see it. And at 67 years of age, I felt confident to be able to do that. This new batch of artists in the 21st century, yeah, the people that speak to me are few and far between because it's a new language that I don't really understand. Hence the title of the record, Out of Sync.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, venture capital firms are frequently accused of focusing too much of their investment on the so-called Golden Triangle of London, Oxford and Cambridge, which, according to a recent report from the Treasury Select Committee, accounts for 4/5 of all such investment. Well, the Edinburgh-based VC firm Par Equity today seeks to address this with the launch of a new £100 million fund to help scale high-growth tech companies in the north of England, Northern Ireland and Scotland. Joining me now is Andrew Noble. He's a partner at Par Equity. Andrew, welcome to you. You've already raised £67 million. Where's that come from?
Yes, we are delighted to announce the launch of the fund today, and we've had fantastic support from some of our limited partners, our investors in the fund. That's come from the likes of the Scottish National Investment Bank, British Business Bank, Strathclyde Pension Fund and the University of Strathclyde, alongside another 40 limited partners in that fund as well, supporting this strategy.
So the types of businesses you're looking to back, at what stage of their development will they be at? Will this be seed financing, or will they have already done perhaps a Series A or B?
So they will have already completed their seed funding rounds, and this is at the most critical juncture in that startup's journey. This is when they move from seed through to product market fit and ultimately scaling of those businesses. So this fund will target Series A rounds of between 5 and 20 million into some of the best technology companies across the north of the UK.
Are there going to be enough opportunities for you to invest in?
Absolutely. We have no shortage of opportunities for us to invest into, particularly across the north of the UK. You have to remember that the north of the UK has a very rich engineering and manufacturing heritage. We've got incredible academic institutions across the north of the UK as well. Scotland, as an example of that, has the most world-class universities per capita of anywhere else in the world. And furthermore, when we take a step back and we look at that macro level, the north of the UK is a $1 trillion economy in its own right. That is the 8th largest, or the equivalent of the 8th largest country in Europe and the 20th largest in the world. So we are absolutely certain that we have opportunities to invest the fund.
So why do you think some of your industry peers overlook these opportunities?
Yes, it's a question we've been asking ourselves for many years. At Par Equity, we've been investing across this market for 15 years, and we have seen that shortage of capital firsthand. Ultimately, Ian, it is due to that proximity, that geographic reach of a VC firm. We are very network-driven and relationship-driven as a business, and what that has meant is that most of the funding goes within 2 hours of where the venture capital firm is based. And that's ultimately led to the fact that there are only 9% of 25 billion of capital that goes to North of the UK because of that concentration of VC money in London.
So it's VCs not being prepared to wear out a bit of shoe leather, then?
I wouldn't want to pass that comment, but it could well be that.
How far south will you go? I mean, will a company from Birmingham meet your criteria, for example?
Yes. I mean, it's a bit blurry when we talk about the lines, but ultimately it's that arc from sort of Liverpool, Manchester, Sheffield, Leeds and Hull and north of there. And certainly we've got teams on the ground in Yorkshire, for example. We've just opened an office and we're increasing our presence in that region as a foothold in the north of England to get after some of these opportunities.
What did you make of the recent decision to call a halt to HS2's further expansion north of Birmingham?
Well, I think it's a bit of a political hot potato. But, I mean, ultimately, what we want to see is the north of the UK getting the investment that it deserves. Unfortunately, with HS2, that means it's a further delay to that, and it means that the north of the UK is just less connected to London and the capital that's able to flow from London into the regions.
This is quite a big undertaking on your part, isn't it? I mean, this represents more than 60% of the total that you've invested to date since 2008.
That's right. I mean, we have been investing since 2008, and over that time, we've been largely focused on those sort of pre-seed and seed rounds. Of late, we've been investing a lot more into sort of early Series A, but the real opportunity that we're seeing firsthand is that proper Series A funding, £5 to £20 million rounds, as I mentioned.
So you've got 67 million already. How quickly are you going to be starting to deploy that?
Well, we've just made our first close, so we are already looking at a live list of opportunities to invest into. I'm pleased to say that 2 of those are already well advanced, and we expect to close out those deals in the coming weeks. Taking a step back, however, what we will be doing is targeting around about 12 to 15 companies across a 3 to 5 year investment period.
Excellent. Well, come and keep us updated on it from time to time.
Fantastic.
Andrew, good to see you today.
Thank you.
Well, before I go, some breaking news now on the future of the Telegraph. I'm joined on the phone by our city editor, Mark Kleiman, who has the story. Mark, what have you heard?
Yes, Ian, a big potential twist this morning in the battle for control of the Daily Telegraph, the Sunday Telegraph and the Spectator magazine. Now, what I understand is that the Barclay family, which of course owned the Telegraph from 2004 until this summer, has tabled a £1 billion bid to Lloyds Banking Group, which it owes that money to, in order to wrest back control of 2 of Britain's biggest broadsheet newspaper titles. Now, these talks are still at a relatively early stage, but I can reveal that this bid was tabled in the last few days and that the Barclay family believes that this will be sufficient to derail rival bidders' hopes of buying the Daily and Sunday Telegraph newspapers. Of course, in recent weeks, we've been hearing about figures like the hedge fund billionaire Sir Paul Marshall and his hopes of buying the Telegraph. But the Barclay family has tabled this latest offer, the latest in a series of proposals, with financial backing from Abu Dhabi investors. And it believes that if it can gain traction in talks with Lloyds in the coming days and weeks, it will be able to secure control again of the Daily Telegraph and derail that planned auction of the titles. This will unfold in the coming year.
OK, thanks, Mark. That's it for me. I'm back at 4:30 this afternoon with our afternoon edition. Hope to see you then. In the meantime, do stay tuned. Up next, Anna Botting's in Tel Aviv and Jane's here in London. See you later on. Cheerio.